Hello viewers, welcome to our channel. I know all of you would love to earn some passive income. There are various ways by which we can earn passive income, and today in this video we are going to see how we can do that. So let's begin. There are 7 sources of income and dividend income is one such source how you can earn passive income. Mutual funds or stock has 2 sources of returns. One is appreciation in stock prices and secondly it's dividend. 50 years back, the stock market was only for a few individuals and increase in prices of stocks were a great deal and hence stocks would often offer a dividend yield of more than 5 to 6% per annum. Over the years, the policy of giving dividends have become more diverse that companies offer either high dividends, low dividends or no dividends. Dividend yield is calculated by dividing the annual dividend per share by the current market price of the share multiplied by 100 to derive the yield percentage. For an optimist, dividend stock offers the best of both worlds. There is upfront cash and then there is potential upside in the stock price. For a pessimist, a dividend stock acts as a defensive instrument as they provide some comfort to the downsides during the bear market. So now, with some declines in this uncertain market, let's look at some data and analyze if investing in a dividend-yielding stock, ETF or mutual funds will somewhat mitigate the downside risk in one's portfolio. There is a high degree of debate surrounding the fact that by paying dividends, does a company become a more attractive investment bet? There are 3 arguments for these type of companies. Firstly, there is an economic argument that says that most efficient companies can increase their shareholder returns by paying a low or no dividend and plowing back the profits in their own assets, R&D, people, products, and technology which further compounds capital. Secondly, we have the gratification factor and studies suggest that a little amount of money, however unnecessary, could add to your joy in spite of being tax inefficient. Thirdly, there is perception argument wherein the market extrapolates dividend as a signal for price appreciation and a sign of better cash flows and business optimism. So, as you see, there are different angles on dividends and it becomes more visible and evident during bear markets. The last time we saw the bear markets were in the years between 2008 and 2010 when the effects of global financial crisis was at its peak. In a study conducted for the US S&P 500 companies spread across different quarters, it was found that high dividend yield stocks withstood the markets during the downtrend. It was also found out in the study that companies which declared a dividend of more than 17% came out unscathed during the financial crisis by losing only 1% of its value, while the stocks which offered low or no dividends fell by over 35% during those quarters. So the question would come in our minds that why would market participants support high yield stocks during bear market? The obvious answer lies to the yield. Let's say that there are 2 stocks A and B wherein stock A is not paying any dividend and stock B is paying a 5% dividend yield. Let's assume that the stock market collapses and these 2 stocks fall by 50%. Now the second stock is offering a 10% dividend which is higher than the existing fixed deposit rate. From an exit strategy perspective, if you had to sell any of these 2 stocks, it would be stock A that would be sold out due to the fact that dividend support is being given on stock B. Categorically, high dividend yielding stocks are one of the best places to hide during bear markets. At the time of recording this video, there were 52 companies having a market cap of over 1,000 crores offering a dividend yield of over 5%. There are no IT companies in this list, and bulk of these companies are in the metal and mining sector, oil and gas, power generation, specialized financing, and commodity chemicals. Like everything else, a high dividend yield approach has some limitations which are good to know. The first perception is that there aren't too many high yielding dividend paying companies consistently. The second perception is that some stocks appear to have high yield and the truth might be a little distorted or uncertain. Let's take an example of Goodyear, which is presently offering a dividend yield of 9.7%. This year, the company has declared a total dividend of 100 rupees and the current share price is around 1030. So 100 divided by 1030 gives a dividend yield of 9.7%. But the management was never so generous with dividends for many years. In fact, the dividends were in the range of 12 to 13% up until 2021 when the company increased it over 700%. It was a surprise to many as the company now has to arrange for additional funds for paying 200 crores, which in earlier years was only 30 crores. Mathematically speaking, the dividends for FY 21, 22 and 23 were almost double their net profits. This goes to show the level of uncertainty when it comes to paying dividends. Another perception is that many stocks appear to pay dividends because stock has fallen sharply. For example, SAIL has fallen by over 50% in the last 1 year. They offered a per share dividend of 8 rupees 50 paise last year, which came to a dividend yield of 6.5%. So if the company were to offer the dividend of 8.5 rupees this year as well, then the yield would be approximately 13%. The point is that dividends are uncertain and unsustainable, and one also needs to factor in the life cycle of the business as it's generally mature and declining businesses that end up offering high dividends and yield. The primary goal of this category is to invest in companies that offer higher than benchmark dividend yield. Speaking of the benchmark, the Nifty 50 or for that matter Nifty 500 operates at a dividend yield of 1 to 1.5%, which is not much but a good starting point. For the rules prescribed by SEBI, these funds have to invest at least 65% of their assets in high dividend yielding stocks, but surprisingly the regulator has not come up with the minimum threshold of yield that is required for a stock to qualify for investment. This gives the fund managers a lot of flexibility which they utilize to invest in companies that don't pay a dividend or lower dividend. The HDFC Dividend Yield Fund is the largest in this category with an AUM of 2,800 crores. The top 10 holdings of the scheme reveal that very few of the stocks are high dividend yielding stocks, which is a problem when evaluating dividend yield funds for investment. While the funds are tagged as dividend yielding scheme, but the holdings are more aligned to large caps or larger mid caps. But that doesn't mean that these schemes are doing a bad job with your money. This data shows for comparable categories the performance of dividend yielding funds which have been ranked 4th over a 5-year period, 2nd over a 3-year period, and have been the top performer over the last 1 year. Of course, the path has not been a smooth one as these funds stutter a bit during the bull market where investors chase growth stocks without worrying about cash flows or dividends. So it is suggested that if you think of investing in such funds, invest only a fraction of your capital. A fair chunk of investors are gravitating towards high dividend yielding stocks as it adds stability to the portfolio and acts as a volatility hedge. One effective strategy that investors can apply is to mesh it with other factors, especially the defensive ones. I would be happier investing in sectors like healthcare or FMCG where there would be growing demand rather than invest in cyclical sectors such as metals and mining. Similarly, one should invest in low debt company paying high dividends because when cycle turns for the worse, companies would first try to repay the debts rather than pay dividends to its shareholders. Another strategy that one could employ is to substitute their portfolio allocation with dividend yielding stocks instead of fixed income instruments. This strategy could only be used for the long term. This will increase the portfolio yield. Secondly, it will reduce the interest rate sensitivities, but it will also lead to portfolio volatility. With that, we come to the end of this video and we hope that you have learned the importance of a high dividend yield strategy from a defensive perspective, perception perspective, and how it can be a formidable inclusion in your investment portfolio, especially during a bear market. If you like this video, kindly subscribe to our channel, tap the bell notification and share it with your investment community. Until then, have a great day.